Hi guys, welcome to today's webinar. My name is Joshua Matumo, the founder and MD, FourthStreet Consultants. I hope you are having a nice week and the afternoon has been kind to you. Welcome to today's webinar. The topic of today's webinar is the power of trading breakouts and how to correctly trade breakouts. I'll be the one coordinating the webinar, and we're going to cover quite an array of topics under the topic of the webinar, including why are webinars significant in our trading, why should we pay attention to webinars, why are we even having this webinar in the first place, and from time to time I'll be going off the topic to explain some concepts that will help you get a nice hold of the concept that is the trading breakouts. And so I'm really looking forward to a quiet and engaging session with you. I hope you're powered and ready for this. I would like to introduce my partner, a fellow consultant from FourthStreet Consultants, that is George Mogo. I'll just request him to say hi to the audience.
Hi guys. Yeah, this is George. Welcome everybody to our webinar. It's gonna be a very interesting session, and I hope you guys are prepared for this, because this is one of the most profitable trading strategy we actually apply in the forex market. So I'll forward again to Joshua to start us off.
Okay. George makes me feel like I'm a news broadcaster, but it's all good. It's all good. So I hope you guys are ready. I think without wasting further time, we're going to just get right into it. The way that we have scheduled today's webinar is that we have a presentation. I'm just going to put it up on the screen that we've prepared to cover the various topics, the subtopics and areas that we believe are of the most significance as to your understanding of how to trade breakouts and the power of trading breakouts in forex markets. Some of the things that we're going to be covering is how do we tell which is the right breakout to trade? How do we tell between a real breakout and a fake breakout? What is the confirmation that triggers our entry into the trade after the breakout has formed? That and among more, we're going to be covering that. And as well, I want this to be really engaging as far as I'll be using live markets using the EGM platform to show you live examples of how we come about trading breakouts, spotting breakouts, and how to correctly open positions, set parameters of stop loss, and take profit while adhering to the principle of risk to reward ratio. And all these, we're going to be polished on all these within this hour. And therefore, I think I'll just move straight into it. The first topic I'm going to cover is the power of trading breakouts. And we're going to be looking at the definition of breakout. So we're going to be looking at the definition of breakout in a second, just making sure that everything is up and running. And therefore, that's the definition of breakouts. Breakouts occurs in the forex markets when price gets out or breaks out from a consolidation or a trading range, or when a certain market level has been broken, such as a support or resistance or even pivot levels. Breakouts signify a new sentiment or a change in supply and demand among buyers and sellers. All traders understand that the markets are set on the basis of economics of supply and demand. So when a buyer's demand for a currency pair outweighs the sellers, then it leads the market to move upwards or just get bullish, and the vice versa is true. And therefore, when forces of supply and demand change, that's when, after a period of consolidation, that's when we experience breakouts. Then the next thing we're going to cover is that just before I move forward, you can feel free to forward your questions. And at one point between the webinar, we're going to be addressing some of your questions as we cover the various topics. And therefore, we'll be key to make it as engaging as possible. And therefore, moving forward, we're going to cover the next subtopic, which is why breakouts? Why do we trade breakouts? Why are breakouts important to us price action traders in the forex markets? This is the first point, is that understanding why and how breakouts occur in forex trading is quite a significant aspect of successful and profitable price action trading in forex. What if I told you today that we have traders in the forex markets who trade forex market and live out of their career just by mastering how to trade forex breakouts? This is real. It's such a powerful trading strategy that, if well mastered and practice of it over time, it can prove to be really profitable. And moving forward, I'll tell you why this is so. The next point as to why we trade breakouts and what is significant in trading breakouts is the understanding and differentiating between which is a real breakout and which is a fake out. That is of even more important. That is after you're able to recognize how to identify breakouts in the forex charts. And in a few minutes, I'll be taking you back to the charts where we're going to find out how we locate some of the breakouts, how we go about trading them on live markets, and it's going to get more engaging. The third point I'll cover on why we trade breakouts is what makes breakouts powerful strategies in trading is due to the fact that they occur after a consolidation. That is, after the markets have built a certain momentum and they're kind of a regular movement kind of pattern, thereby creating an imminent imbalance on the prices among buyers and sellers. You remember my point about demand and supply, buyers and sellers. Buyers are outweighing sellers, or sellers are outweighing buyers and pushing the market. This is the same point. And therefore, I would put this like in two people who are fighting, who have been fighting for long. The fight being consolidation, and they're looking forward to break and access freedom. And this is the only way out, is by overpowering one another. And therefore, the moment one conquers the other, then they're out in the space to enjoy the freedom. And this is why breakouts are such a powerful tool in trading the forex market. And therefore, the one who overpowers the other, in this case being a war between buyers and sellers, bulls and the bears, then takes over the market. And oftenly, when breakouts happen, it's actually preceded by very long moves in the forex market. And this is one of the reasons why we're careful to analyze them and to use them to our advantage when we're opening trades in the forex markets. Moving forward, the other point that makes breakouts really significant in trading forex is the fact that they offer us a significant risk to reward ratio, thereby increasing our odds of making profits while keeping our risks exposure low. There's a thing they say in forex that the first goal of a forex trader is not to lose money. The second goal is not to lose money, and the third goal is not to lose money. Now, why breakouts appear as quite a significant tool is the fact that they enable us to get a proper risk to reward ratio of 1 to 2 to 1 to 3. And this is the ultimate goal, or this should be your ultimate goal as a forex trader. Remember, we always say in price action and in forex trading, less is more. By this we mean have less trades and then weigh up on your quality of the trades. If you have a few quality trades in a month or 2 months, then you're good to go. Unlike other capital markets or businesses, in forex, less is more. And therefore, we always aim to get trades that can offer us a significant risk to reward ratio. And trading breakouts is one of the ways that if well mastered, can really make you a profitable trader. Moving forward, we're going to be covering the various ways in which we identify and trade breakouts. One of the avenues that we'll be covering in today's webinars is the channels. How do we trade breakouts within channels? How do breakouts appear or form within channels? How do we go about opening positions based on breakouts forming within a channel? Then of course, we're going also to cover triangles, and we're going to cover wedges. The good thing is that if you are a new trader, because this is quite an advanced level of the topic we have, then we're going to be covering, because I'm going to be drawing these channels live with you on the live markets, as well as the triangles and wedges, and we're going to be showing you how these patterns come about and how do we trade breakouts based on these patterns. So it's about to get more exciting as we near to get into the live market in order to spot these patterns and to locate favorable breakouts in the real market, as opposed to the PowerPoint presentation that is showing on our screens. And therefore, moving forward, we start off by looking at channels. How do we spot breakouts in channel? How do we trade breakouts based on Forex channels? It's important to just mention on a light note what are channels. These are channels are formed between parallel support and resistance lines. They indicate a relatively strong trend with the price trading within the lines. A breakout occurring in a channel indicates either a reversal in the trend or a change in the slope of the trend. I have a few examples of drawings of chart patterns that indicate, well, in Forex, you normally have three types of channels. We have a bullish channel, we have a bearish channel, and we as well have an horizontal channel. And therefore, at this point, I would like us to go straight to just open our charts and try to spot some channels on some currency pairs. We just get live on the market. Just trying to position my audio as well for you to have a better view of the charts. And therefore, open on our screen is an EGM Securities account, and I want to get you now into the meat of the webinar to identify some of the channels that we previously have located on the Forex markets, and we're going to be using them as examples of how we trade breakouts. How do we come about identifying a breakout? And we're going to start by looking at an ascending channel that we spot at the currency pair of the Great Britain pound against the Canadian dollar. That pair right there. So I'm just going to delete the arrows and show you how do we come about identifying a price channel before even we head up to identify the breakout. One thing that I should note, or I must let you know in Forex, is that whenever you're drawing chart patterns on Forex, you never have to force chart patterns to match up what you want. Instead, we follow the markets. For instance, when you're drawing a price channel, you look at the swings high and the swings low. And of course, even by looking at the naked charts with your eyes, you can outrightly tell that there is a channel that, a bullish channel that forms starting from this point here, where I'm going to draw an horizontal line starting from below here. And it's going all the way to this point. That's the first line, whereby we've joined the swing lows of the bullish channel. And then, of course, you pick up an horizontal line and spot the swing highs of this channel from down here, and then you can take it all the way to the top. And that's obviously a clear price channel that we have. See how simple that was. And therefore, we get to learn that this channel has held ground since 25th August, around there, up to around 9th of April 2018. That's almost like 9 months price channel. And therefore, at this point is where now we get to look for breakout. Remember my definition earlier when I was starting the webinar that breakouts happen or when prices breaks out of a consolidation or a ranging market. And what has happened within this channel is that prices have respected the boundaries, that is the support and resistance of this channel, of this bullish channel. And it is at this point, I'm just going to insert a shape right here. It is at this point that this channel broke out of its a long trend, that is the 8 months, and this is where we find a breakout happening. Then the next question would be, okay, the markets have pushed the prices, or the sellers have pushed the prices from the channel that has held grounds for quite a while, but what really based on such a breakout? Just going to change the color thing for you for better visibility. What really informs us as traders to open positions based on such a breakout? Because this is how simple it should be to locate these patterns and even locate breakouts in Forex markets. Anyone who tells you Forex is complicated, then they're misguiding you. It should be clear, it should be elaborate. The thing is, learn how to draw these patterns, identify the area where the norm is broken. That is, for instance, in our case, we have an eminent price channel that was broken at this point, and therefore this level is where the breakout happened. But then as price action traders, as professional traders, we don't usually rush to open positions just immediately after the breakout happens. And therefore what we wait, and what we always wait, and something I'm going to cover as we progress with the webinar, is that we always have to wait for confirmation candlesticks. For instance, this is a bearish breakout from a bullish channel, and if I were you or any professional trader, wouldn't open a position outrightly at the price of 76.80, but rather I would have waited, or we should have waited, for the next strong bearish candlestick, which is right here, this candlestick that I'm indicating here. So this is the candlestick that should have acted as our confirmation signal to open a sell position based on this breakout on the bullish channel. Then the next question we would ask ourselves, then, where would be the appropriate place to position our stop loss? We always position our stop loss just a few pips above the breakout candlestick. This strong bearish candlestick that I'm placing the cursor on was our bearish breakout candlestick, and therefore you just do a mathematics of a few pips. Usually we take 15 to 20 pips above the breakout candlestick. That's where we position our stop loss. Then of course we look to achieve a proper risk to reward ratio, because at the end of the day, if a trade doesn't offer you a proper risk to reward ratio, then it's not worth taking. Just analyze and look for the next opportunity. The markets are not in a hurry. These opportunities will always show up. This is the patience that we as traders are required to uphold as we approach Forex trading. That is, if successful and consistency in making money in the Forex market is concerned. And therefore, if I were in the market at this point, I would have placed my stop loss up there. Then, of course, I would have targeted a risk reward ratio of around 1 to 2, and that would have given me this price level of 71.13 as my target take profit. And therefore, this is how one of the ways you trade breakouts. You wait for your confirmation to happen. You don't open trades outrightly after the breakout has happened. I'll move forward to highlight another example of breakout based on a price channel. But at this point, I think I'm going to give George just half a minute to add a comment on this example that we have. So, George, kindly, you have a word. You have anything you'd like to add to our audience?
Yes. I would like you to concentrate on how the breakout occurred. We had a strong bearish candle, penetrate the support line,
which is connecting the
connecting the
swing
swing
lows,
lows,
and
and
then
then
afterwards
afterwards
we
we
have
have
a
a doji. If Josh could zoom in a little, you can see an indecision candle, which is covered extensively on our course of price action trading. We see there was an indecision, and right after the indecision, we had a strong follow-up. That is the confirmation. There was indecision, and then a decision was made. It is that simple. This is not something that is complicated. You just have to stick to your rules.
Thank you, George. Thank you for that. I think to just wrap it up about what George was saying was that there was an indecision after the breakout happened, and therefore the market was unsure. Nobody was controlling the markets, the bulls and the bears. There was kind of a battle, and at the end of the day, on that day, since this is a daily time frame chart pattern, is where now the bears took over the market and pushed the market down, and this is what acts as our confirmation to take position that is open or sell position based on such a breakout. And therefore, moving very fast, I'm going to cover just a second example of descending channel. And we have analyzed the market pair of the US dollar against the Japanese yen to give you an example or to just showcase another nice breakout. Now this time, this is a bearish price channel, and I just deleted my horizontal lines to show you how simple it is to spot such channels. And having spotted the channels, all we do as traders is wait. One of the guys I admire in Forex is Warren Buffett, and one of his most famous quotes as a speculator or as a trader in the Forex and stock markets, Warren Buffett says that 90% of the time he is not trading. He is waiting, he is watching the markets, or he trades 10% of the time. This further acknowledges to my ideal that it's not multiple trades, it's just quality trades. And therefore, I won't indulge too much into that level of wisdom, but we are racing against time, and I'm going to help you draw a descending price channel that is quite eminent and clear to our eyes. And this is how you draw a descending price channel. You just join up the swing highs and the swing lows to come up with a clear price channel. And what we experience here is yet again another eminent breakout that happened towards to the close of this descending price channel, like right where I'm indicating using my eclipse shape. And let me just zoom in a bit. So this is our bullish confirmation, the candlestick that I'm pointing the cursor at. This is our bullish confirmation candlestick. You remember when I was talking about why are we even discussing about trading breakouts? And one of the reasons I gave is that breakouts helps us. They are such powerful trading tools in that they enable us to risk less money while we're targeting higher returns. Because look at this example that we're having on the pair of the US dollar against the Japanese yen. After the confirmation of the bullish candlestick, because if I was trading on the market, this would be my entry point after the bullish candlestick has actually confirmed that the sentiment has changed from the price channel and buyers have pushed the prices up and broken out of the channel. And this is a proper example of a breakout. And therefore, I would position my stop loss around in the middle of the channel, just a few pips from the breakout candlesticks. This would be my ideal place to position my stop loss at the price of 100.26. And then, of course, I would target a proper risk to reward ratio. I wouldn't be too ambitious about it. This is already a risk to reward ratio of around 1 to 2 or 1 to 2.5. But then you see, I would have banked early profits on this pair if I was taking this trade on the market. And you see what happened afterwards. Even after your take profit is hit, the market went on rising. And A topic that we probably would cover in another webinar would be how to scale your trades. For instance, when you trade in the profit zone and you clearly see there is high momentum for the markets to trade on your direction, there's a scale we call trailing your stop loss. This is why you move your stop loss up, and to the extent whereby your trade is trading at a no risk level, and therefore I would move my stop loss probably up a bit, and then of course extend my TP or my take profit up here, of course, given on my judgment on how much the bullish momentum was on this pair. That's a topic for another day. What we never mess with is we don't shift our stop losses, but when you're trading in the profit zone, you maximize to make the most money out of it. And this is a whole different technique, and we cover this all these strategies and all these techniques in our comprehensive price action course that we offer from at our company. This showing here is just a close look at our website. We have a forex course, a comprehensive online forex course that is quite covers this and even more. And therefore, moving forward, so this is quite clear. You see how significant this could have been in terms of offering you a very classic profit, loss to profit ratio, which is the ultimate goal of any trader out there, and this should be your goal as well. Now, I just noticed how much time is rushing, and I need to speed up my pace in covering this topic as we have a lot. And so I'm going to further move on to the next example, the next topic that we're going to cover on how we trade breakouts, and that is based on triangles. As you see, we have different shapes and types of triangles that are forming on the charts. On our PowerPoint presentation, as you can see. Just a simple definition: a triangle pattern is usually formed between converging support and resistance lines. We have two types of triangles, that is ascending triangles and descending triangles. Even more exciting now, let's move into the market itself. I want us to try to locate an example of breakouts that happen within triangles. What would be the point that I would probably mention regarding breakouts that happen within a triangle is that just like we covered on the price channel, is that breakouts that happen within a triangle offers us a very classic risk to reward ratio. It actually enables us to risk a very little amount of our capital. We expose a bit of our capital while we target higher profits. And this is the essence of consistent profit, trading and making money in the forex market. So if any trade doesn't offer you a greater reward than the risk you're exposing your capital to the market, then it's not worth taking, and you should revise or probably seek education or just learn the markets and be patient to wait for the best setups. Moving on to the charts, an example of a triangle we're going to cover is on the US dollar, Japanese yen, US dollar, Japanese yen. We moved back, we just analyzed the market back as we were try to look to spot a very nice triangle, and moving back. You know what they say about history repeats itself. You know what they say about price action. You know what they say about certain patterns that have happened before, last week, last month, last year, 5 years ago. They will happen again. They repeat themselves, and the mastery of these chart patterns is what forms or guides us as price action traders. And therefore our job is to master these patterns, as we're doing right now on this webinar. Master how they happen, how we take advantage of them, how we use them to make them our edge. And therefore, again, I'm just going to delete there. Now, developing an eye to catch some of these patterns takes a bit of experience, but with a close eye, and if you really understand how these patterns come across, and especially when you're trading higher time frames, because something you realize in all our setups is that we concentrate on the higher time frames of the weekly and the daily. A full day of trading, a full week of trading gives you a stronger sentiment as to the long-term direction of the forex market. And this is why at FourthStreet Consultants, our trading is usually based on the higher time frames. And we have a strategy that we analyze the markets called the top-down approach. This is also covered on our Forex course, on our comprehensive online Forex course from our website. This is where you analyze the markets from the higher time frames of the monthly to get the higher sentiment of where the markets are headed in the higher time frame. Then you can analyze, look for opportunities down to the lower time frames of the daily and the 4-hour, whereby your decisions on which direction you take up your positions needs to be aligned by the higher time frame. For instance, if the long-term time frame is on a monthly, then it would make more sense you following the higher time frames when you're opening a position based on the daily or the 4-hour. Sorry, I always step out of the topic. Now let's draw this triangle. This is where we spotted a symmetrical triangle, and I'm just going to draw the edges and join up the curves, and that's our symmetrical triangle right there. See how simple it is once you spot the edges and the pattern is eminent on a weekly time frame. See, there's something I mentioned about trading triangles and basing our trading decisions on breakouts based on triangles. See, what happened here is, let me just zoom in a bit for you. So this is our triangle, and this is how you spot and draw a triangle. Then you see markets were trading while they were consolidating to the edge of the triangle. And what happened thereafter, because at this point, at this level where I'm drawing the horizontal line where the markets were here before the following trading days occurred, I'm assuming this was our current market position. At this point, you wouldn't have known whether it's the bulls or the bears that are going to take control of the markets. And therefore, our job, as I said, as Forex traders, especially price action traders, is to always wait for market to guide us. We follow the price. We don't enforce our will or what we think about the markets upon the markets. We follow the price. See, what happened here is there was an eminent breakout that happened, and it was a bullish breakout. There was the first candlestick that hit or that broke out of this triangle, and then it was followed by an indecisive candlestick, and then it was followed by another bullish candlestick. And if I was trading the Forex markets, then this candlestick that I'm pointing the arrow at would have acted as my confirmation trigger to enter a buy position based on this breakout, based on this triangle. And therefore this would be my ideal entry price level. Those traders who have issues or challenges trying to find out which is the correct trigger to enter your trades, these are some of the things you look out for. You look out for confirmation candlesticks to confirm that the sentiment of the market has actually shifted. And therefore this would be my entry price level. Of course, my stop loss would be a little bit below the previous candlestick in the triangle. That would be ideally, I would ideally place my stop loss at this price. And of course, I would position my TP a bit high to make sure that I target a risk reward ratio of at least 1 to 1.5 or at least 1 to 2. That would be quite an ideal place to position my TP. Or if you don't want to be ambitious, or you should understand yourself, how much patience can you hold a trade for as a person. In Forex, it's very important to understand your personality, because your trading strategy and your trading plan should always align to your personality. If you understand that you're personally not a really quite a patient person, you can't wait for several weeks for your trades to work out, then you'd probably target a lower risk to reward ratio, which I strongly advise against. But the point is, it's very important to understand your personality as a trader and develop your trading plan alongside a personality, a trading plan that fits into your personality. And therefore, this is how you identify a triangle, and of course, open positions based on a triangle. Probably I'll call George back in the room to add on a few pointers, probably 1 or 2, then we can move forward.
Oh yes, I would like you to note the time it took for the trade to work out. Remember, we are following the higher time frame. This is on a weekly time frame, And you can see after the breakout, the amount of mindset and discipline that is required in this art, because you can see the amount of ranging that happened before actually the, the, the rally started.
That's it. That's it. Thank you, George. Thank you, George. George usually has a lot of contribution. He's actually trying to limit his conversation and contribution into this, but I think we need to reschedule and just get more time for these webinars to just share our experience and wisdom into new traders, because this is what we essentially do at 4thStreet Consultants. And therefore, I'll just move right ahead. I realize I can't cover all examples given the time, how fast the time is moving, given we have 1 hour. And so what I'm going to do is jump next to the next price action patterns, from where we look for to spot opportunities based on trading breakouts. And this is the wedges. Just a simple, quick definition of wedges. That wedges are actually quite similar to triangles in that they are formed between converging support and resistance. The difference is that whereas support and resistance in a triangle have one positive and one negative slope, the support and resistance of a wedge would both have either a positive or a negative slope. Wedges with a positive slope are called rising wedges, whereas those with a negative slope are called negative wedges. Did you hear some jargon there? That's I know that can, especially for new traders, can get them thinking a lot, but I'm just going to break it down for you as much as I can. So this is essentially the definition of wedges. What I'm going to do to even help you understand better is get right into our charts and try to spot an example of a wedge that we already analyzed the markets and spotted on one of the pairs. And this is a rising wedge on the pair of the Great Britain pound against the Japanese yen. That is the Great Britain pound against the Japanese yen. Traders out there refer to this pair as the monster. George, why do traders refer to this pair as the monster?
Yes, this pair,
on a light note,
this pair is actually a very volatile pair, and volatility is not something that you get easily. So the pound yen is a very volatile pair and moves very fast. That's why it's referred to the monster, and it moves very huge distances within a blink of an eye. So traders have a good history with this, but definitely, you know, the 90% usually cry. Yes.
I'm not sure that's a good way to tell starters, but even to add on top of that, we as traders feed into volatility. And therefore, if a currency pair has a higher volatility than other currency pairs, more opportunities, we most probably going to come across more opportunities, trading opportunities on that pair. And therefore, a monster is known to move, to make humongous moves or just long strides. It's one of the pairs that you can identify and make a lot of money with. And at the same time, if you're not careful about your money management, and it can as well lead to your dismay on your capital as a trader. So this is a risky business. You need to understand how the market works, how the dynamics of the market set up, how do the forces of supply and demand affect the forex markets, how do you shield yourself against a lot of risk exposure to just make sure that you safeguard or you guard your capital in order to catch the next trade. Anyway, so we're going to help you. We're going together to draw this wedge that we spotted on the pair of the Great Britain pound against the Japanese yen, and just drawing simple lines adjoining the swing highs of this pair. This is on a weekly time frame. As I mentioned, you rarely find us analyzing markets on lower time frames of, let's say, 30 minutes. I guess the lowest, and we barely at 4thStreet analyze the markets, is 1 hour. We prefer higher time frames of the 4 hour the daily to the weekly. This is where the market, a lot of market noise and spikes are eliminated when you analyze the markets approaching them from a higher time frame. And this is something that most professional traders or traders who have been out there on the markets will agree with me. And of course, I'll remind you, kindly keep sending your questions, your sentiments. Is this webinar helpful? Are you learning? This actually works a lot to keep us going. And of course, we keep on responding to your questions. I'm going to take the last 10 minutes to take a few questions that you will have forwarded to us. So I encourage you to just let's keep on doing this. I'm enjoying the webinar. I hope you are enjoying as well. You need a glass of water, you need some coffee, just fill up the cup. Let's learn the markets. Let's learn how to professionally trade the forex markets and make a living out of trading the forex markets. And therefore, I'm just going to further draw this wedge, and therefore I'm going to simply just join the swing lows of this pair right there. Okay, that's it. This is how you simply identify and draw a forex wedge. You see the upper boundary, the resistance line up here, and the lower. You see the difference between. You remember in my definition when I was stating the difference between how we come about wedges, and the difference between how we come about triangles. This is the difference because you realize that the line of support, that is the upper line, and the line of the line of resistance, the upper line, and the line of support, which is below here. Both lines are facing to the same direction of the bull, unlike lines of a triangle where the support line is facing the opposite direction, while the resistance line is facing the other direction. For a wedge, both lines mostly or should face the same direction, as we can see on this example that we have. Let me just zoom in a bit for you. So this is where, again, our breakout happened on this pair. I'm just going to insert a simple shape right here. I'm using the tools that are available for us by the EGM Securities platform, which I find quite ideal and adequate for professional traders out there. The navigation and the latency is quite okay. I have used their platform, and I'm comfortable using this platform. So this is where the breakout happened. Let me just draw a line right here. Spot this bearish candlestick. So this is our point of breakout based on this wedge. Something I would like to note here, unlike all these other examples that I've been giving before, you find that after the bearish candlestick formed based on this wedge breakout, we actually had a series. This is why you always insist on always waiting for a confirmation candlestick before you can open a position. Patience, patience, patience. See what happened. There happened, a bearish candlestick happened. Then as we were waiting for a second confirmation bearish candlestick, it formed a kind of a reversal pattern, and the market consolidated a bit. There was indecision, and at this point, this is where you keep away from such a pattern. And until there's a proper breakout, or the bears have actually taken over the market and pushed the price down, as to what happened at this level, this is where now gives us a go ahead to open positions based on this pair. And if this would be our entry price level, then of course it would be ideal to have this level up here as our stop loss. Good thing with this example is that it's within the current market. As you can see, the market is active. It's still trading. Trading activities are taking place. It's still active, and therefore, if I was to open a position on this, I would have targeted my TP or my take profit to be down here. This would have given me a very nice risk to reward ratio of 1 to 2, and this is the essence of it. And my TP would have been hit by this fakey candlestick that went below this line and just went back up. So this is another example of a breakout based on on a wedge. I think I'm just going to cover another one example very fast on the wedge, another example based on trading wedges. Then from there, I'll cover one more subtopic about trading breakouts and how to identify fake breakouts and to stay away from such. Then from there, I'll open up and take a few questions from our audience. Then we'll take it up. So I'm just going to give another example on the pair, going back to the charts. This is an opportunity or a trading pattern that we located on the currency pair of the New Zealand dollar against the Canadian dollar based on the daily time frame. This was an opportunity that occurred back in 2017, and we had to flash back the market, go backwards to identify these opportunities. And these opportunities that keep on repeating themselves. You know, as the old saying that history repeats itself, and this is the beauty of price action. Whether you join up the forex industry tomorrow, next week, so as long as you master these patterns, master how to trade them correctly, master how to wait for confirmations, master how to plan your money management plan, have your psychology right about the markets, don't have high expectations, do not force your sentiments or your thought into the market, wait for the price to always guide you. As we always say, price is king in forex trading. And therefore, without wasting more time, I'm just going to draw together with you this wedge. This is an example of a descending wedge. The previous wedge we're covering was a rising wedge. This is a falling wedge, and you just join the swing highs of this wedge right there. Then you join the swing lows right there. Move it lower a bit to make sure it doesn't cut out some candlesticks, and there we go, and we have a proper wedge. Now look at how this breakout formed. Look at how massive profit anyone who would have taken this opportunity would have made from the forex markets. Even better, look at how significant, if you placed a stop loss on this pair based on the opportunity that the prices show us, and you see how far the market headed up in the days that followed up, because this is our, let me just showcase using an horizontal line. Okay, so this is our breakout bullish candlestick from this descending wedge. But then, as I said, we always wait for confirmation. It's very easy, as we'll be going to be covering the next last topic, it's very easy to open a position and then the markets just fake out and get back into the wedge. And therefore, this is why it's quite paramount to always wait for confirmation. And what would have acted as our confirmation candle would be the next bullish candlestick that happened after the breakout bullish candlestick. And the horizontal line at the price of 89.21 would have been, of course, my entry trigger. This would be my entry level. Once this trading day closes, because this is a daily time frame, then this would have acted as my point of entry into this pair. Where would I have placed my stop loss? Of course, I would have placed my stop loss right about the open of the breakout candlestick right there. That would be a safe place for me to accept. You know what stop losses mean is that at this level, if the market turns against me, then I agree that I was wrong. And therefore, this is a very important element to any professional trader, to always swallow your pride. And when the market goes against you, you can't be right, you know, all the time. There are losses in forex market, and this is just like any other business. Just like any other business, patience is key. Patience is key, not just in forex. Patience in spirituality, patience in relationships, patience in business. In life, it's an attribute in life, and it's not different in forex. Actually, in forex is where patience is required most. And therefore, the patience to actually be patient to wait for a confirmation candlestick to happen will differentiate you from the 80% of traders that lose money into the 20% that make money. You can differentiate yourself from the losing traders and be among the profitable traders. Therefore, this would be my stop loss at the price of 8771. Then, of course, this would be my entry price level. And of course, I would target a nice risk reward ratio of around 1 to 2 or 1 to 1.5. Right there, you see the level or the distance of my stop loss is quite small as compared to my target take profit. And this is because professional forex trading and having a proper risk to reward ratio to just make sure you're always ahead of markets. And this is the fact, if you instill a discipline of always being patient to wait for trades that offer you a nice risk to reward ratio, this is why even if you had a spread of 10 trades and you lost 6 out of the 10 trades and actually had 4 trades right, based on the mere fact that your risk to reward ratio was well spaced. And this is something that most traders have an issue accepting and actually growing the discipline to trade along, and it costs a lot of traders because you can't be actually, the professional quote is that if you write 5 times out of 10, then you're actually a very good trader. That is in the long term. But if you write 4 times out of 10 times and you're wrong 6 times, with a proper risk to reward ratio, you're still above threshold. All these disciplines are covered in our comprehensive forex course that is actually online. You just access it from our website, and you can always learn from the course from wherever you are. You visit our website, that is FourthStreet.co.ke, and you can always sign up. We have our contacts in case you need to inquire anything. We offer consultation to our students both on phone, or they can always visit our offices which are based at Karen to get mentorship and consultation. And therefore, we're very passionate about mentoring traders and not just selling out a course out there. And this is what we have. The course is a forex course. Once you sign up, you pay up, you get your logins. It's a lifetime access to a comprehensive course. And the price that you pay for the course comes with 6 months free consultation, as I said, either on phone or you can visit our offices. Just call, book a consultation session, and you can have a one-on-one consultation. And therefore, this would be my ideal position to place our take profit. And of course, as we see, look at what happened. The market moved further to push up, and this is how strong or how reliable trading and mastering breakouts is. At this point, I'll ask George to point in 1 or 2 points, how he feels generally about the topic, or pointers that I would have probably missed out before I head out to the last subtopic. We are running out of time. I'll just request George to take a minute or less to just throw out his comments and his feelings about the whole topic.
So I would like to add on why breakouts. Why breakouts? Huh? One, not to get caught in ranging markets. You don't want to hold a trade for so long and the market is not moving. As you can see, once we have a breakout, a clear trend is established, and that is good for us. I'm sure you would like to have your profits taken as soon as possible. The other thing is you catch trends early. You get the right timing in the market, which is very hard to accomplish. Getting the right timing is actually an art. It is one of the things that people struggle with, even experienced traders, having the right entry into the market. And the other thing is the final part, why breakout. You get low risk trades. As you can see, all the trades we have demonstrated, they actually had more than 1 to 2 risk to reward ratio. There was a lot of opportunity, a lot of room for more profits, and that's why trading breakouts is one of the best price action trading strategies ever invented. And one thing Josh might have not pointed out is that always when we break a level, not always, but most of the time, we have a pullback. And this now gives you, if you are late on the breakout, you can rejoin. And as you can see, the demonstration on the NZD card, we had a breakout and a pullback in form of a series of pin bars and dojis. And these candlestick formations are covered extensively in our course. And that gave us a re-entry so that we could go long.
Thank you, George. That's definitely a killer point as we head forward to conclude on our today's webinar. Thank you, George, actually, for pointing that out. I think I wouldn't have forgiven myself if we ended the webinar without having put that across. Taking advantage of retracement on a price action pattern. Well, I will agree that this is definitely a whole subtopic in itself, but it's definitely a very strong point worth to note, because let's say you weren't at the market when this confirmation happened, and you come back at the markets, you've already lost the opportunity, and instead of regretting, you just be patient for a retracement to happen. Not all the time that retracements happen, but often than not they happen. And if you happen to miss out on an opportunity, retracements are a nice way to catch up. Just re-enter into the trade, because what George was meant is that there was this retracement of this horizontal line that I've drawn in the markets. The bulls took off the market, and the bears tried to fight the market, pushing the prices of the pair down. And then this strong bullish candlestick that I'm pointing the cursor at, this would be my trigger. If in case I missed on the earlier entry, then this would be my confirmation candlestick to open a long position to make money on this pair. And therefore, this is a very important point that George has noted. Is a whole point, but there is just a lot. There's just a lot to learn in Forex. But with the right mentorship, with the right guidance, you can grow this experience and learn to be a professional and profitable trader. Therefore, I see we running quite out of time. I'm going to cover one final subtopic, and this is on fake breakouts. Now, I think we've actually covered this subtopic in my discussion, where I have been insisting all along that one of the most surest ways to open positions is wait for confirmations. And waiting for confirmations before you trigger your trade or open your position helps you to not fall prey to fake breakouts, because what fake breakouts means is that well, I'll just read through it. These are market scenarios where price breaks past the support or resistance level, be it in a price channel, be it in a triangle, be it on a wedge, but only to move back or to retrace back into the trading range, therefore ending up to be a fake breakout, which sucks out people who entered the trade prematurely, therefore selling off their capital. And this can be caused mainly by two things. One of the most common aspect that causes this to happen is news releases. We all know about the markets or pushes market, but what happens in market spikes is that they don't last for long. So, and often than not, most market spikes are followed up by a retracement back into the predominant trend of the market. The other thing is that, of course, at the end of the day, and I think this point 2 encompasses point 1 as well, is the imbalance in forces of supply and demand. And therefore, these are the two things that cause market spikes to happen. And the only way to be sure and to approach trading breakouts and to make money from trading breakouts is to always wait for confirmation signals to happen. I'll just repeat this: wait for confirmation signals to happen before you can trigger your entry. If you haven't learned anything today, let this be your takeaway. Always wait for confirmation signals. This is actually not just in trading breakouts. Actually, in our course and in all the topics and strategies we cover, this being part of it, there is no point where we guide our students to open trades without having confirmed that the sentiment has actually changed and they are odds of making money are more on their side than against them. Therefore, let this be one of the biggest takeaways. The only way to be sure to approach trading breakouts is to always wait for confirmation signals. And I think that's almost put us to the close of our webinar for the day. It's been an exciting, I actually enjoyed it. I didn't realize how much time has gone past. But let me just finish up by showing you an example, a small example of a fake breakout that happened on the pair of the Euro Audi that you already analyzed and identified to explain to you based on the Forex markets. Now, right here, let me just zoom in a bit. Well, the problem of zooming in, you lose the bigger picture that I wanted to show you. So I'll just zoom out once again. And what we see on this pair of the euro against the Australian dollar is that this candlestick right here, the long tail that happened actually a few days ago, I think, not a few days, a few weeks ago, I think 3 weeks, around 3 weeks ago, I think, yeah, if I'm not wrong. So this is an example of a fake breakout. And therefore, you could have actually been, been caught up in thinking that these spikes, when if you were at the market when it was forming, you'd actually easily been fooled that, bulls have a lot of buying power and they're pushing the prices up. But then see how wrong you could have been, because within the same trading week before close of the week, this candlestick actually retraced, forming a long wick. The tail of the candlestick, we call it the wick, forming a long wick and a bearish body back into the consolidation. And you see the pair is still bearish as the market is, we're on the current market price of 59.15. And this is an example, a classic example of a false breakout. Breakout, why? Because this level, if you zoom out further, you find that this is a long-term level that the market has been unable to break past it in as far as 2015. This is a very strong resistance level. Since September 2015 up to date, buyers have not been able to break this level, and this is why we experience a very strong fake out of a breakout that anybody could have thought, before it happened, that it was going to be a breakout to the upward side. But then you see how much the virtue of waiting for confirmation candlesticks would have saved you, because of course you wouldn't have opened a position when this week wasn't going. You would have waited for the next week to confirm your sentiment. And this is how significant, waiting for confirmation candlestick is of essence to trading the Forex markets. And therefore, I'm just going to request George to read me one or two or three questions that we probably have gotten from our audience. Then I'll respond to 1 or 2 or 3 questions. Then I'll give George the opportunity to respond to probably 1 or 2 other questions that are quite different from what I cover. Then actually, let's make it 2-2. Then from there, we can just wind up on a webinar. And George, kindly.
Yeah, thank you, Josh, for such a lovely webinar. It was quite helpful. I enjoyed a lot too. We have a question from Eric. He said, I find that if I use my daily charts, I risk a huge percentage of my account size. Does it mean I should add more funds to risk recommended about of 2%, or what is the recommended account start?
Wow, that's quite a wide up question, because what I got from his question, it's Eric, right?
It's Eric, yeah.
What I got from Eric's question is that he's trading based on a daily time frame, which is a very nice time frame to trade. But my challenge or my question to him would be, what kind of a trader are you? What strategies are you opening your positions based on? Is there a clear price signal that informs you to enter the position in the first place? Because trading based on the daily time frame is not enough. Trading based on the weekly time frame is not enough. you need to develop the skill of identifying an opportunity, a clear price action opportunity. Then the other point is, I don't know what kind of a trader are you. Are you a price action trader? Are you a fundamental trader? But the bottom line is daily time frame, weekly time frame, 4-hour is classic time frames. I think what you need to do more, because the question of how much you risk into the market has nothing to do with the amount of capital you have. Because what happens is you have a specified money management plan. Whatever capital you have, whether you have $1,000, whether you have $10,000, if your risk exposure is, let's say, 3 or 4%, regardless of the size of your account, that doesn't change. The bottom line is look for quality trades. Make sure you have signals that actually inform you to take a position. How do you take your position? Then you can, of course, work on how to set your levels of stop loss. Make sure that the trade actually offers you a nice risk to reward ratio. Then I think your trading results will change tremendously. Another question, George?
Yes, we have a question from Desmond Dagunda. Suppose you do catch a trend. Is there any way of measuring how much of your account you should risk? Any way to indicate the strength of a trend? Since some are stronger than others, and you obviously want to risk more on a stronger trend and less on a weaker trend.
Wow, Desmond. You know, when it comes to trade, when it comes to forex trading, at 4th Street Consultants, we're passionate about trading. I won't tell you what makes you happy. I'll tell you what works, what doesn't work, how you're supposed to approach the forex markets. And there's a point I heard Desmond state about how much of your trading capital should you risk based on how strong a signal is. Or the other question was, how do you tell between a strong trend and a weak trend? Unfortunately, that's a whole topic on itself. But definitely, we tell the strength of a trend based on the inclination or the angle in which the trend appears. For instance, let's just use the pair that is open on our charts. Let me try to see whether we can spot. Now, follow with me from the price of 39.28, where I have placed my horizontal line. See what happened after this level was the buyers took over this market. This is an example of a strong trend. You see the inclination, the angle of inclination from where the trend started and going up. This is how you tell how strong are these bullish candlesticks that are forming one after the other. If it's weak, if it's a bit sluggish, for example, actually this is a good example. Look at let me do something real quick. An eclipse. Look at this trend. This is an example of a nice bearish trend. It's a tradable trend, but then this is not as strong as the other trend that is quite almost vertical and strong with bullish candlesticks. This is much of a weak trend, and therefore when you're making your decision on which trend you want to ride on, then these are some of the things you look. What's the level of inclination? How strong is this trend? It's something you can actually tell from just looking at the charts. And therefore, as to the question of capital, then that is a question of money management. Before you even open a position, you should always, of course, have a predetermined risk exposure that regardless of how many trades you open at any one point, you're not going to be risking a certain percentage of your risk capital. You need to learn how to develop a money management plan so that whenever you're on the trade, no matter how good a strategy looks, you preserve your capital. Remember when I said the first rule is to preserve your capital, second rule is preserve your capital, third rule is preserve your capital. And therefore, this is a very important element, and this is of course, I think for me, what you need is more mentorship on this. And of course, you can always call us up, even probably before even having to take our course, and we can offer you guidance on more of these. You can reach us on our social media pages. We have a Facebook page, we have an Instagram page. This is our Facebook page. Of course, we have contact details on our website. You can always feel free to call us. You can come over, visit us, let's have a chat. Even if you're not taking the course, we just take you through, you can ask your questions, and you can decide later whether you really need the course to polish your skills. So feel free to contact us using our social media pages, as long as the contact details on our website. And therefore, I'll give this opportunity to George. Please address one or two questions, then we can wrap up the webinar, as we're quite running out of time.
Okay, thank you so much, Josh. There's a question, but the user went offline. Can you draw lines? Can you draw channels, wedges, triangles using line chart? And you can do that, but you do not recommend you do that, because you'll be just solving one piece of the puzzle. Price patterns shows how the general behavior of the big money or the investors, but to get the precise information, candlesticks, that's where they excel in. We make trading decisions based on the candlestick formations. So when you use line chart, you lose a huge part of price action. And I think some people may be tempted to use bar charts or line charts, but we recommend using candlestick charts. Yes.
That's it.
Yeah. There was another question, but this was how often will you have these webinars?
How often will we have these webinars? Now, that's a good question. I was going to mention it as we wind up on today's webinar, and so I'm just going to get right onto it. We've scheduled a total of 3 webinars in partnership with EGM Securities, the only non-dealing forex brokerage firm registered in Kenya. Today is our first webinar. We're going to have another webinar exactly a week from now, on Tuesday next week, same time. Follow our social media pages, that is our Facebook. Follow EGM pages, Facebook and their Instagram, and you'll find links on how you can register and join up on our upcoming webinar. And then the other Tuesday, I think, is on the 5th. We'll have our third webinar. So follow up on our social media. You get to see the topics, and we will of course be covering different topics every webinar session. The next one is going to be on Tuesday next week, same time at 3 p.m. And we look forward to you joining us. We really hope you had a fantastic learning session. And I think at this point, I'll just wind it up at that point. Thank you for everyone who has facilitated this webinar to come into completion and to be fruitful. Thank George for being part of this. Thank the EGM, our broker partners. Then and just wish you well. Wish you all the best. Of course, this has been recorded. We're going to post it on our YouTube channel, and I think on our Facebook as well, social media. So follow our YouTube channel, 4thStreet Consultants. We have a couple of more videos there, very educative, and this video will be available in a day or so. So in case you joined up late, or you want to refer a friend or something, it's going to be available on our database. It's going to be available on our social media pages and on our YouTube channel. And at this point, I say thank you for your time. Thank you for being a great audience. Thank you for being active. Thank you for your questions. I enjoyed the session. I can keep on doing this, and I hope to see you next week. George, come on over. Just say bye to these guys. Show up your face here. Yeah. And well, from me and George, it's a wrap. All the best, and